In December 1982, corporate raider T. Boone Pickens launched a hostile tender offer for El Paso Natural Gas, targeting controlling equity at a steep discount to asset value. The traditional defense playbook relied on costly buybacks or white knights, both of which drained liquid cash reserves. Inside the firm, executives watched as open market accumulation threatened to strip management of control within days. The impending corporate takeover exposed a structural vulnerability in capital allocation. Attorney Martin Lipton stepped into this power vacuum with a radical legal architecture designed to alter board governance. Instead of burning capital to outbid hostile suitors, Lipton authored a defensive clause known formally as the Shareholder Rights Plan. His instrument granted existing equity holders the conditional right to purchase additional stock at a massive discount once an unsanctioned buyer crossed a specific ownership threshold. The core power of this mechanism rests on severe equity dilution. When an unwelcome acquirer buys 19.9% of outstanding voting stock, the rights plan activates immediately. Every existing shareholder except the hostile bidder receives the right to buy new shares at half price. This sudden supply flood dilutes the acquirer's percentage stake while multiplying their financial cost to achieve absolute voting control. Focusing on this mathematical barrier reveals how it completely flipped the economics of hostile takeovers across global markets. Before Lipton created the poison pill, raiders used cheap junk debt to secure controlling stakes and strip corporate assets. Under the new regime, crossing the trigger threshold meant absorbing self-inflicted portfolio destruction. The financial penalty was designed to be mathematically unpayable, forcing hostile bidders to negotiate directly with corporate boards. The legitimacy of the Shareholder Rights Plan hung on Delaware legal precedent. In the seminal 1985 case Household International, the Delaware Supreme Court evaluated whether boards possessed the legal authority to adopt the defense without explicit shareholder approval. The court ruled that adopting a poison pill fell under the protection of the business judgment rule, establishing that directors had a fiduciary duty to defend corporate autonomy against coercive bids. That legal victory fundamentally redefined the balance of power between shareholders and executive leadership. Boards were no longer passive entities forced to accept high bids. Armed with the pill, directors gained the authority to block tender offers, delay buyout timelines, and demand higher acquisition premiums. The defense transformed the boardroom into a fortified command center, stripping hostile bidders of their speed and surprise advantage. Wall Street institutions initially fought back against the deployment of the poison pill. Institutional investors argued that the mechanism insulated entrenched management teams from performance accountability and suppressed stock valuations. Pension funds claimed that preventing shareholders from tendering stock directly stripped investors of their basic property rights. Yet, despite institutional outrage, board after board adopted rights plans to guard their balance sheets. The immediate consequence was a permanent shift in corporate acquisition strategy. Hostile raiders could no longer rely on quick tender offers funded by high-yield debt syndicates. Instead, acquirers were forced to combine tender offers with proxy contests, attempting to replace incumbent directors with candidates who promised to redeem the poison pill. The battlefield shifted from public equity markets to annual shareholder proxy voting ballots. Over time, corporate attorneys refined the poison pill into increasingly sophisticated variations. The flip-in pill allowed existing shareholders to purchase target company shares at a discount, while the flip-over pill permitted target shareholders to buy stock in the acquiring company at bargain prices after a merger. These dual layers created an inescapable economic penalty, focusing institutional focus on negotiated settlements rather than forced market takeovers. The arrival of the poison pill altered target company valuations during merger negotiations. Empirical market data revealed that firms protected by rights plans commanded higher acquisition premiums than unprotected targets. By eliminating the threat of a swift hostile takeover, boards gained crucial leverage to solicit competing offers, extract cash adjustments, and force prospective buyers to pay full fair value. Consider how the mechanism operates during a real-time defense against an activist accumulation campaign. An aggressive hedge fund acquires 12% of floating shares on the open market and demands immediate board seats. Sensing an impending control change, the target firm activates its prepackaged shareholder rights plan. The threshold triggers. Discounted rights distribute automatically, and the activist fund faces catastrophic ownership dilution if it acquires one additional share. Legal challenges against the poison pill continued to evolve alongside changing corporate practice. Courts established strict standards under legal precedent, requiring boards to demonstrate that a hostile bid posed a genuine threat to corporate enterprise value. Defensive measures were required to be reasonable and proportionate to the threat posed. If a pill was deemed purely entrenching, Delaware judges stepped in to invalidate the defense. This judicial oversight created a delicate balance between management discretion and shareholder rights. Directors could not use the pill to block fair acquisition offers indefinitely without risking personal liability or court intervention. Instead, the pill served as a temporary pause button, giving boards the operational time needed to explore strategic alternatives, solicit superior bids, or demonstrate long-term independent value. In the modern era of activist investing, the poison pill has adapted to meet new structural threats. Passive index funds now hold massive voting blocks, changing how proxy battles unfold across public equity markets. Activist investors rarely seek outright acquisition. Instead, they target minority governance stakes to force spin-offs, asset sales, or capital return programs. The modern pill is often designed with lower ownership triggers to counteract covert synthetic stake building. Derivatives and total return swaps allow modern investors to accumulate economic exposure without triggering traditional disclosure requirements. To counter these hidden accumulation strategies, corporate lawyers updated poison pill language to include derivative holdings in trigger threshold calculations. This adjustment ensured that synthetic positions could no longer bypass equity dilution defenses, preserving board visibility over hidden control shifts. The mathematical architecture of the pill remains its ultimate deterrent. When triggered, the rapid creation of new shares causes an immediate mathematical shift in per-share book value and voting equity percentages. The acquirer sees their capital commitment multiply overnight, while their relative voting weight collapses. No financial engineering strategy or high-yield financing package can absorb that level of sudden equity destruction. Despite its efficiency, the defensive tool faces ongoing criticism from modern corporate governance advocates. Governance proxy advisory firms often recommend voting against directors who adopt rights plans without shareholder ratification. As a result, many contemporary companies keep a poison pill on the shelf, fully drafted but unadopted, ready to be formally deployed within hours if a hostile threat emerges. Looking back at Martin Lipton's 1982 invention, the poison pill fundamentally altered the trajectory of modern capitalism. It marked the transition from an era of unchecked corporate rating to a structured framework governed by board discretion and strategic negotiation. The Rights Plan transformed corporate charters from vulnerable open balance sheets into fortified institutional structures capable of resisting predatory market pressure. The global spread of the mechanism expanded its impact beyond American capital markets. International financial centers adapted similar defense concepts to protect national champions from foreign acquisitions. While regulatory frameworks vary across jurisdictions, the underlying thesis remains constant. Equity dilution serves as the ultimate defensive barrier against unauthorized corporate control transfers. Today, the dynamic between activist funds and corporate targets relies on a delicate strategic equilibrium. Investors know that crossing a pill's specific ownership threshold means instant portfolio damage. Consequently, modern battles focus on proxy fights, public campaigns, and director negotiations rather than direct hostiles. The poison pill reshaped market behavior not by eliminating corporate transactions, but by establishing strict rules of engagement. The legal legacy of the Rights Plan continues to be tested in court battles involving modern technology megafirms and distressed corporate acquisitions. Courts consistently reaffirm that when directors act in good faith and with due care, the poison pill remains a legitimate exercise of corporate board authority. It stands as a masterclass in legal innovation, converting basic stock rights into an unyielding shield against hostile capital takeover attempts. Ultimately, Martin Lipton redefined corporate governance by recognizing that power in public markets rests not merely on capital volume, but on structural rules. By inventing a mathematical barrier to acquisition, he gave boardrooms the power to determine their own destiny. The poison pill remains a testament to how legal design can reshuffle institutional incentives, permanently altering the mechanics of corporate acquisition.